And thanks to CFA Society NZ and the New Zealand Private Capital Group for helping with the webinar this afternoon. So kia ora tātou everybody. Just a bit of context for you. We've got three speakers, Sharon, Sean, Matt, in that order, 9 minutes each, Q&A afterwards. There's no Chatham House rule today, so whatever people speak will be ascribed to the person speaking, so that's fine. And we'll have Q&A afterwards. I'll moderate that, throw in some questions myself if required. We've got 600 at least registered today, so hopefully you've all not got COVID and sitting at home miserably deciding to listen to us, but you've come on this webinar because you want to hear the quality of the speakers, which is terrific. So just by way of context for everyone, US 10-year government bond yields 2.14%, New Zealand equivalent sitting at 3.15%, so 100 basis points above, and our 90-day rates at 1.56. You might remember that on the 11th of March 2020, WHO declared COVID-19 a pandemic. So almost 2 years later, we're still in the middle of the throes of the pandemic. And we had our first lockdown 26th of March, which lasted until the 30th of May 2020, when the economy was effectively closed. On the 23rd of Jan this year, Omicron appeared and we moved into red status. And on 24th of February, Russia invaded Ukraine. So it's been a really unusual time in financial markets as much as the real world, and we're still struggling with the impact of that through supply chain logistics, inflation, asset prices, and also what Sir Peter Gluckman called the emergence of what appears to be lack of social cohesion, which manifested itself in the protests and parliamentary grounds a couple of weeks ago. So these are really challenging times for everyone. Don't underestimate those. So it's with pleasure we've got three speakers to guide us through their thoughts on the current state of affairs as they see it and how they see things unfolding. So Sharon, I'd like to invite you to speak first.
Thanks very much. I've got a few slides to gallop through. So there we go. Party's over. I think that's kind of the theme of the year. We had quite a party actually, right in the middle of the pandemic, which is quite a bizarre kind of phenomenon. But what have we learned about COVID and economics? Well, quite a lot. We've kind of learned the hard way. But basically, given the fiscal and monetary support, it actually entails a series of quite short-lived demand shocks, with demand bouncing back very, very quickly after the restrictions eased every time. On the other hand, the impact on the supply side of things has been much, much more persistent. So we all thought we were looking at a couple of months of shipping disruptions. It's gone on and on and on. But it just keeps getting more and more tangled. And now, for example, we have an invasion of Ukraine, which is going to really muck up supply chains for both energy and food, two pretty fundamental goods. And we also have Omicron in China, which is another leg of supply chain disruption. So it just keeps coming. We've also seen a big substitution from travel in particular, but experiences more generally to goods. That has been extremely resource intensive, and it's been huge. So the upshot of all of that is it is a highly inflationary negative supply shock, not a very deflationary negative net demand shock. Oops, because central banks responded as if it was the latter, as if it was the global financial crisis. And it's important to note that it's not like everyone else was telling them they were morons at the time. The uncertainty was huge, and it was very understandable, but you can see the result there. Inflation rising everywhere, and now we've got another negative supply shock on top of what was already a big problem. So yes, it's not a great starting point, one could say. So here, zooming in on New Zealand, you can see there in our business survey, cost expectations, pricing intentions, inflation expectations, all still going up. No sign of anything topping out there, with 70-something% of firms experiencing higher prices and 92% in the last read experiencing higher costs. And this was before the invasion of Ukraine. And that's despite the fact that the activity indicators have been coming off. I mean, most obviously in the last read because of Omicron, but even before that, they were weakening. So it's a pretty unpleasant mix for central banks, weakening activity, but still rising inflation pressures, because one would say cut rates and one would say hike them. But it's not just oil prices. So it's very difficult for the Reserve Bank to just say it's just going to wash through and we can ignore it, because the starting point is so bad. And it's also such broad-based inflation. It's not just imported, it's wages, it's core inflation, it's inflation expectations. It's that type of inflation that doesn't go away on its own, basically. It's the type of inflation you can only beat by opening up a negative output gap, driving activity below the potential rate of output. And unfortunately, that potential rate of output has itself taken a hit from both COVID and now high energy costs and the like. So you're talking about needing to slow the economy potentially quite a lot to get on top of inflation. That's pretty ugly. But the fact is, inflation is the only thing that counts now for the central banks whose credibility is on the line. If you lose credibility and you allow inflation expectations to drift off to wherever, you've really made a rod for your own back and potentially going to have the worst of all worlds. You could have an economic slowdown that doesn't actually get on top of inflation. And then you're sort of in a true stagflationary world. So Adrian Orr said, I will not play fast and loose with my inflation targeting credibility, and we believe him. So we're anticipating quite a robust response with 250 basis point hikes in both April and May. And at the moment, the employment, the labour market is also flashing green for hikes. That may not stay the case. So if I were the governor, I'd be tempted to get in while the going's good. But this is just the number of job ads divided by the number of people who are unemployed. And you can see we are miles above what the Reserve Bank estimated was maximum sustainable employment. So the bad news is that definitely ups the ante on a potential wage price spiral. The good news is that we think the economy could actually slow quite a lot before we start cutting into the meat of actual employment. So we'll take that. Unemployment's at a record low despite record high labour force participation. So that's a pretty unusual situation. So here you can see that households are not happy. The headline confidence tanked, but we think that's probably COVID impacts. But this question, is it a good time to buy a major household item? That has the best correlation with real retail spending. And at the moment, you can see households really don't think it's a very good time at all. In fact, it's worse than during the global financial crisis, or about the same. To be fair, all through 2021, they were saying that, but they were saying one thing and doing another. Their levels weren't great, but the spending was phenomenal. And I think that's that substitution effect plus 40-something% increase in house prices will do that. But now reality is starting to bite with interest rates going up, house prices going backwards. The CPI up nearly 6% already, and now we've got petrol on top of that. And COVID risks and wealth effects going backwards. All these things mean that households are going to pull their heads in this year. The only thing on the other side is a very strong labour market. But even there, real wages are currently going backwards. Wages will catch up with the labour market this tight, but they don't respond as quickly as prices do. So we're right in that really awkward squeeze for households at the moment. So here's the housing market. You can see it's in full retreat. House sales actually started falling a year ago. House prices have got the message. The number of available listings is rising very quickly. It's flipped over to a buyer's market. Now that we're forecasting quite aggressive OCR hikes, we see double-digit house price falls, just -10. But really, that line is just dropping like a stone. So exactly where that bottoms out is anyone's guess. But certainly with mortgage rates going up pretty quickly, that will make it quite difficult for people to enter the market. There are the swap rates that underlie mortgage rates. As you can see, it's been pretty much one-way traffic. So there's probably still a little bit of pipeline pressure there, and obviously more in the likes of the 1 year if we are right that the Reserve Bank's going to go all out for a period. Then those probably have still got a bit further to go. Very unusual for the Reserve Bank to hike into falling house prices, but that's what they were already forecasting in February. So it's just a question of degree. They're already talking about doing something unprecedented, and the upshot is they're very, very late with tightening. So on the one hand, that means they need to scramble to catch up. On the other hand, it does mean there are real questions about how far they're likely to get before something goes amiss. And there's lots of things, obviously, that can go amiss, and I'm sure the other speakers will talk about some of them. But this is truly a global phenomenon with central banks now scrambling. They're not investors' friends anymore. They've got a job to do. This is the reason central banks were made independent, is that they would do the unpopular, tough stuff when inflation is a problem, because there's no way politicians would want to hike rates into a slowing economy. Just quickly on commodity prices, they've moved with oil prices. That's really great from a national net income point of view. Very unusually, they're going in completely the opposite direction to the New Zealand dollar. So that's happy times for dairy farmers and other exporters. It is contributing, though, however, to looser monetary conditions. And finally, there's our inflation peak. We're picking 7.4, but the fuel tax cut does knock 0.5% off that, perhaps, which would normally be a really, really big deal, of course. But when you're talking about 7.5 or 7, less of a big deal. We haven't revised our forecast yet because there's plenty of other moving parts. But you can see their non-tradables, how high that is relative to normal and how slowly we've got it coming down. And that's really where the rubber hits the road. Finally, just on the Taylor rule there at the bottom, that's how central banks normally respond. You can see that they've actually they're very late. And so our forecasts have them playing catch up and then getting a couple of quick 50s under the belt, and then they can go more cautiously and wait and see how things are going. And the market's largely on board with that. The dark line there is the Reserve Bank's February forecast. The light blue is ours, and the disgusting beige colour is current market pricing. So lots of things could derail hikes, the housing slowdown, if the unemployment rate were to rise, if inflation expectations were to tank, which seems very unlikely, or global markets got really messy, which, to be honest, seems a bit less unlikely. But that's perhaps a good place to stop and segue effortlessly to the next speaker. Thank you.
Thank you.
Thank you. Sorry about that. I'm going to come at this from a broader global perspective, and I'll talk about 4 key issues that are in focus due to the Russian invasion of Ukraine. So each of these are worthy of probably an hour on their own, but given Craig's very tight time constraint, I'm going to rush through this and highlight some of the most important issues and repercussions of these. Now, I'm going to use a few slides, which I'm going to try and share with you now to run through this. I'll spend a couple of minutes on each slide, and hopefully that's working. Yep, great. And then we'll have some time for Q&A at the end. So the 4 things I'm going to talk about are listed there on screen: reserves, Europe, China, and then investor decisions. And we'll start off by talking about the shock to international reserve holders. So since the time of the Asian financial crisis in 1997-98, all economies have paid much greater attention to their FX reserve position. And it's a signal to global markets about their ability to withstand a crisis and to defend their currency. And if I go back to 97, total FX reserves globally were $2 trillion. At the end of last year, the amount was $15 trillion. And the key assumption that all nations have about their FX reserves is that they can always be accessed no matter where they are. That is, the assumption was that they were always money good. Now, that's no longer the case after Russia's reserves were frozen last week. At the time of the Ukraine invasion, Russia had approximately 630 billion in FX reserves at its disposal. It had been building those reserves steadily in recent years to protect itself from the type of sanctions it saw after it annexed Crimea in 2014. And part of its strategy was to reduce its exposure to US dollars and increase its holdings of euro, Chinese yuan, and gold. And you can see that in the middle of the chart there. Western sanctions on Russia have locked up about 2/3 of Russia's reserves. And the Central Bank of Russia was thus unable to defend the ruble last week when it effectively halved in value. And this was the first occasion in history that a G20 central bank has had its foreign exchange reserves frozen in this way. So what this means is that for the first time ever, G20 central banks and global ratings agencies and investors have to give thought to the notion that what they assumed was unencumbered money may not actually be the case. And that has huge long-term implications and repercussions for global credit markets. It likely means that hard physical assets that can be stored onshore will increase in popularity, and gold is a typical example. It also likely means that there'll be increased diversification away from the major G7 Western currencies. So for any central bank that's potentially going to become embroiled in a conflict or a disagreement with the USA or the Western powers, this is a big wake-up call. China's got approximately 3.3 trillion of reserves available, of which about 2 trillion are denominated in US dollars. 1.1 trillion of those are in treasuries. What they've just seen is that with the press of a button, those reserves can be locked up and made inaccessible to them in a future crisis. Now, that's not going to be an acceptable risk that China or any other country is going to be willing to take. And so what we would expect is that going forward, the way in which currency reserves are held will change, as will the format. And currently, of the 15 trillion in global FX reserves, around 80% of that amount is held in US dollars and euros, and that has to change. I'll talk about Europe now. It's been more than 75 years since Europe has had a state-to-state land war of this type, and that's raised the risk premium on European investment. In recent years, investors have effectively ignored Europe's growing energy concentration risk on imports from Russia, and military and nuclear conflict risks, they haven't been thought about since the 1980s. So all investors now have to rethink their pricing and the risk reward of holding European assets. And the Europeans themselves are well aware of this. Europe is thus a weaker and, in my view, a more risky investment destination than it was before the invasion. Now, perhaps the biggest surprise in this crisis has been the remarkably fast and completely unified response of the European Union and the UK, with support from the rest of the world to the invasion. The crisis has perhaps made the European continent, including the UK, more united than at any time in the past 30 years. That's very positive. And the response has effectively suggested what I think the FT called an interpretation of the Europeans that this is a war on Europe rather than a war in Europe, which I think is quite significant. The most significant change of all has come in the form of Germany's incredible rejection of its post-1989 pacifist foreign policy and its move to increase its defense spending to more than 2% of GDP. And Berlin's also reversing Germany's rush to embrace green energy that's left it dependent upon Russian gas. It's now talking about refiring coal-burning electricity plants and reopening nuclear generators that had previously shut down. And one of the most striking things along with this has been that it's private companies that have acted sometimes beyond what the governments are requiring them to do, and at great expense to their shareholders. So BP and Shell in particular have written down billions of dollars in investment that they've made over the past 20 years in Russia. And many of these companies will not go back into Russia, even if the sanctions were to be lifted tomorrow. The third topic is about China. What I'll talk about is that here is that it's clear that the invasion of the Ukraine and the Western response has made Russia more reliant on China, or it will make Russia more reliant on China. And that's elevated the position of China in the global economy and the global supply chain. Approximately 2/3 of Russia's reserves were blocked off, as I mentioned. What the Russians can access is that they had about 13% of their reserves held in Chinese yuan and about 25% held in the form of gold. So combined, these give them about eight months worth of import cover for their economy. So Russia will necessarily have to lean more on China as its conduit to world markets if it wants to find a way around the sanctions. The People's Bank and the Central Bank of Russia have FX swap lines in place, and the Chinese did swap rubles for RMB after the Crimean annexation in 2014. China will also likely increase its imports of Russian oil whilst reducing what it's buying from Saudi Arabia, and it will pay for those in CNY to the Russians. Russia will also probably seek to access the Chinese payment system via the Chinese version of SWIFT, which they use to move money around the world. That system's called CIPS, C-I-P-S, and it's been steadily growing in recent years. I'd note, however, that its global use is a fraction, and I mean a fraction of the size of SWIFT and the CHIPS systems that are used by most Western banks. So this won't be an easy way around the sanctions. But one of the things that we saw last weekend following the withdrawal of Visa and MasterCard was that Sberbank, the largest Russian bank, said it would start using Chinese credit card provider UnionPay as an alternative to MasterCard or Visa. So from the Chinese perspective, the Western response to the invasion will have surprised them with the speed of its reach, the speed of the response and the reach of its response. And the imposition of sanctions will convince them that they need to accelerate their measures to disintermediate payment flows from Western systems. And they'll be aware that the reason that Western sanctions have been so effective this time is that compared to the Soviet era, the Russian economy is much more open and much more vulnerable to sanctions. That's a strategic weakness that the Chinese will seek to insulate themselves against. The last section is about supply chain security. Every country in the world is now looking at how it can onshore its most important materials and processes to better protect itself from any kind of external interruption. The Germans, as I said, they've announced that they'll reduce their dependence on Russian imports of oil and gas. They realize that their reliance on Russian energy imports is actually limiting their ability to impose the full set of sanctions on Russia, because it's the country that provides them with the majority of their energy supplies. They can't do without Russia. The Chinese president said last weekend that China must not rely on the rest of the world for its food needs. He wants more farmland set aside. The Australians are clearly starting to build a bigger defence capability to defend their economic interests in the region. And that includes a direct investment they announced yesterday in a steel plant that will make military grade steel plates. And countries around the world are suspending food exports and exports of essential elements that they want to retain more onshore control of. So these changes are going to have some significant repercussions. Amongst other things, they'll increase the amount of economic inefficiency that exists around the world as the benefits of comparative economic advantage across borders are partially suspended. Governments will insist on more things being done domestically for security rather than economic reasons. And that will add to the inflation pressure that Sharon talked about and that we're already seeing through the supply chains. Energy in particular is more than ever a security issue, and oil independence is more than ever a genuine security asset. And the move towards greener energy that I mentioned before and decarbonisation, that may necessarily be suspended in the face of real energy security concerns. So those who've got business plans based on a greener future may find them difficult to execute. So last slide, food security. This has been highlighted by Xi Jinping, as I mentioned. Prior to the invasion of Ukraine, few people would have been aware that Russia and Ukraine account for about a quarter of the world's global wheat and barley exports and 20% of corn. And many of the developing countries, especially in North Africa, are nearly 100% dependent on relatively cheap Ukrainian wheat. And the Arab Spring is now in everybody's mind as food prices rise again. Russia and Ukraine also play key roles in the supply of fertilizer to global food markets, and interruptions in supply chains will drive up farming costs, and they will drive down production volumes of food if no fertilizer is available. So from an investor perspective, this crisis should give asset allocators pause for thought about what risks they're actually taking. Investing in Europe is a different proposition today than it was a month ago. No one was factoring in war or talk of nuclear threat. Investing in countries like Russia and China must necessarily carry a higher hurdle rate now, as the risk of your capital becoming trapped in those countries has become clearly shown. And some have said that recent events make Russia and China uninvestable. Now, whether or not that proves to be the case is not yet clear. But what is clear is that every investor has to think much more deeply about the political and geographic risks they're taking, rather than just focusing on the ROE or ROICs that have dominated most investment decisions over the past 30 years. So that summarizes my 4 points, and over to you, Matt.
Do that, Matt. I'll just ask a question of Sean, which is Russian debt now C-rated by Standard & Poor's and Fitch. Payments due this week. Do you expect them to default?
So what they've done is they've created this list, Craig, of unfriendly countries, which is basically anybody that said bad things about Russia. New Zealand is on that list. Yes. If you're an investor that's domiciled in one of those unfriendly countries, you may be repaid, but you won't be repaid in hard currency. So if you own a dollar bond or a euro denominated bond, they may pay your interest, but they'll likely pay it in Russian rubles, which of course nobody wants, especially given the collapse in value, and those rubles are effectively trapped onshore. So I think one way or another there'll be a default. For the market, the technicalities of all this are around the definition of default, with different bonds having different definitions, and those definitions determine whether the credit default swaps, the CDS, whether they pay out or not. So you're going to get a mixed outcome on this.
We have swapped larders for butter in the 70s, so is that a prospect we get into bartering?
Yes, I think it probably is. The Russians have historically been very good at that, but right now it's very difficult for anybody to transact with the Russians apart from the Chinese and the Indians.
Yeah, cool. Sharon, just a question for you. One of your slides had a very clear indication around policy mistake, referring to the RBNZ being behind the curve. Do you think markets are all on your side? They also believe there's a policy mistake and they have to move quickly?
Well, I certainly wouldn't pick just on the Reserve Bank. In fact, they were quicker off the mark than most. But nonetheless, if you look at the rule of how they normally would have responded, given where inflation and the output gap was, then yes, they were late, because their least regrets said, well, would rather have a bit of an inflation problem than a deep recession. And that was fair enough, but they, with the benefit of hindsight, probably hung on to that a little bit long. The fact that the market OIS is pricing a track, at least initially, that's similar to ours, suggests that people do think that they will focus on tackling inflation in the near term. The market is, however, reluctant to price the OCR going as high as we are forecasting, and that's entirely reasonable because our forecast does assume the wheels don't fall off. And there's obviously plenty of risks around that could mean that the Reserve Bank has to stop before they complete the hiking cycle again, because they're starting late. They might just simply run out of runway. Thank you.
Sean, one of the consequences of having your reserves frozen by a third party is complete implosion of trust in the international financial and payment system, and you can see the flight to gold and other reserves being a consequence of that. But does that have implications for platform systems such as Bitcoin, where there isn't an arbitrary regulator sitting in between transactions?
I've had this question a number of times this week, Craig. I think it's a great question because this effectively goes to the very essence of why people believe that crypto is the answer to so many issues. But for a central bank to diversify into crypto, especially in the volumes that we're talking about, and these numbers are absolutely astronomical. We've got $80 trillion worth of global GDP, and you've got $15 trillion worth of reserves. Even a fraction of those going into crypto would move those markets an incredibly long way. The risk for all central banks with crypto is that they lose control. And that's why they're walking into this so carefully and so steadily. And they're all looking at CBDCs, central bank digital currencies, so that they can have a foot in the camp without losing control. But I think for supporters of the crypto argument, this is a good example of why you might want to have something outside of the regular system. For those who doubt it, one of the points that they would highlight is that this was a prima facie case where Bitcoin and Ethereum and the other cryptocurrencies should have performed really strongly. You've got a flight out of rubles and a flight out of the Ukrainian currency that no one can pronounce, and yet we didn't see a huge run up in the price of crypto. And that was surprising because we did see it with Venezuela and some other countries. So I think the likelihood of the official reserves going into crypto at this stage are limited, but I'm sure it will encourage some savers to go there.
Okay, a couple of questions coming through now. Early Q&A while we wait for Matt. Sharon, just that divergence of Kiwi dollar versus commodity prices or soft commodity prices expressed with dairy. Can you adequately explain that divergence?
Yeah, so basically the Reserve Bank jumps on three different horses without any warning switches between them. One is dairy prices and our commodity prices more generally, our terms of trade. One would be interest rate differentials, and the other is that we often trade as a proxy for risk, and in particular China risk, but risk aversion more generally. And it would seem that the latter has been dominating. But that divergence did open up a bit earlier than that, of course. And in terms of rate differentials, the Reserve Bank, as I mentioned, has been prompter than others. So you would have expected that to support the currency, but it hasn't. But I do wonder if maybe there's a bit of a Pavlovian kind of element to the New Zealand dollar response to what's happening in the world, because when you really step back and look at which countries are most at risk here, it's certainly not New Zealand. Now, our dairy prices are a really valuable hedge against higher commodity prices in a national income sense. So it's important, of course, to note that higher export and higher import prices are both inflationary, so it doesn't help the Reserve Bank's problem any. But from a national activity and income point of view, it's really quite useful. So I do wonder if maybe as the dust settles, the New Zealand dollar might come a bit more back into favour, perhaps.
Okay, just further elucidation, Sean, on the role of China going forward, not only what appears to be military support, but now financial support through swaps, etc. Where do you see that effectively bipolar world moving to?
Yeah, it's again, these are great questions. Just before I answer that one, Craig, if I may, I'm not going to stray too much into Sharon's territory because it's a dangerous place for me to go. But I thought you might enjoy this. Hopefully, you can see this particular chart on screen. This came from one of the London hedge funds, and it was a silly little chart that they put out after a week after the Ukraine invasion, and it shows the performance of every major currency mapped against the distance from Kiev. And you can see that the best performing currency at that point was the New Zealand dollar and the furthest from Kiev. So as Sharon pointed out, we're a long way from this, and it's quite a good thing. So I'll stop sharing that. On the China question, the interesting thing will be potentially about how China positions itself with some of the more non-aligned nations or less aligned nations. So one of the interesting things in the UN sanctions votes was who abstained. And we knew obviously China was going to abstain, but India abstained as well. And they were the only member of the Quad that abstained. And I thought that was a pretty significant thing. Now, historically, India's had good and bad relationships, both with Russia and China, but they do import Russian oil, and they've indicated they'll continue to do so in the current environment because they think it's fine as the Europeans are doing that. The other one is Brazil. Brazil has always had a strong relationship with China because of China's iron ore and other commodity needs. And I think it's quite possible that you might get a re-emergence of a BRIC type bloc, so Brazil, Russia, India, China, forming their own kind of trade area. And the Chinese will certainly be pushing for that to be denominated in Chinese yuan. That will be the key for them. So this gives them an opportunity that they've long wanted in terms of de-dollarizing, but it's very difficult to de-dollarize given the dominance of the US dollar.
Okay, thank you. While Kylie's working with Matt in the background, Sharon, could we just turn to kind of categorization of how you see the kind of economic climate? Is it possible to describe it as stagflationary, which is a throwback to the 70s, last century, or is it a different paradigm?
Well, it's certainly got that whiff about it. Insofar as this year we are expecting growth to slow down and struggle, but inflation to keep rising. So certainly the next sort of 3 to 6 months have that flavour to it. Beyond that, our forecasts assume that the Reserve Bank does manage to anchor inflation expectations and get on top of things, and it all sort of comes out in the wash. But yeah, there is a risk that if central banks move too slowly, that those expectations become unanchored, and then they don't depend on how hot or cold the economy is. You just get inflation because inflation. That's not where we sit now, but there's no question that interest rate rises into slowing growth and potentially rising unemployment around the world will be highly political. And so while at the moment, of course, the government's getting blamed for inflation here and elsewhere, and so are quite enthusiastic about the Reserve Bank getting on top of it, I imagine. As the economy slows, that will get much more political. You can even imagine scenarios where the inflation targeting regime itself comes under a bit of political pressure as politicians start to ask the question about whether this really is the best thing for their voters at the moment. I mean, you just have to remember inflation targeting was introduced by politicians because it was politically expedient, and it could be dismantled by politicians because it's no longer expedient. Certainly nothing that one can forecast, and it would be a huge shock, but it's just worth bearing in mind that it's not carved in stone.
So does that mean you accept the continuation of the dual mandates at the RBNZ, both inflation and full employment will continue?
Yes, of course. Our assumption is that the targets will be left absolutely as they are, but they're not equal targets. The inflation target is absolutely number one. And I think that's clear around the world. They are inflation targeting central banks, not employment targeting central banks, although the fact that inflation has been so low for so long has enabled them to focus on their nice to haves. When push comes to shove, it's all about anchoring inflation expectations.
You haven't strayed much into fiscal affairs, New Zealand government fiscal affairs and the borrowing task and the response of the RBNZ to unwinding its LSAT program, but could you argue that the Treasury, the New Zealand Treasury, or the Crown, is assisting with the tailwinds for GDP growth, and that's making it harder for the RBNZ.
It's all going to depend on what that money is going to be spent on. Obviously, building houses is a focus, and that is a very, very constrained area. So that will be pushing up costs in the construction sector, and the government will be well aware of that, but they would say it's worthwhile because they're essentially fixing a market failure. But if it's like balance sheet transfers to ease some of their health or water reforms or that sort of thing, then it's not so inflationary. So we'll have to wait and see what the budget brings, I think. And
are you expecting an expansionary budget?
Yeah, well, the early indications are that there's quite big numbers being thrown around for sure. Although the economy as a whole is doing quite well, it's very clear that low-income households are really struggling. So we saw obviously the fuel tax cuts were a couple of $100 million thrown around. Yeah, there's likely to be more of that support for the people who are really feeling it.
Unless you've got a diesel car or electric car, it doesn't quite work. Okay, Matt, do we have you back?
Yes, you do. Apologies.
Welcome back.
I was kicked out of Zoom and couldn't get back in, so
that's fine.
I will make this very brief.
No, that's okay. You've got your full 5 minutes because we've had some very fine Q&A. So don't hesitate to deliver what you'd like to deliver. So over to you.
Thank you. Negative real yields have been the key crutch for equities over the last 20 years. This slide from the US market that I'm showing just shows you how deeply negative real yields are at around -1%. And while nominal bond yields are now rising, inflation is rising even faster at this point. We do expect inflation to peak, but stay above central bank target ranges and nominal yields to continue rising. So we do see real yields returning to their normal positive territory. This will see investors abandon the chase for risk assets, in our view, critically, including equities. Within the equity market, just taking a short of 3-year view, on the right-hand scale is the real tips yield inverted and the performance of growth stocks relative to value stocks. What we have seen is a very sharp outperformance by growth stocks, which makes some sense. If discount rates are ultra low, you're willing to pay more today for promised earnings out 10, 15, 20 years' time. This is clearly just starting to change, however. In a longer term context, taking a 10-year plus view, this is value versus growth. Growth has been a massive outperformer until recent times, as investors have begun to take note that central banks have lost control of inflation, that yields are rising, and that real yields will follow. What negative real yields have done is drive an unprecedented wall of money into equity markets. According to Merrill Lynch estimates shown here, 949 billion net flowed into equities in 2021. That is greater inflow than the previous 20 years combined. Real yields have forced investors up the risk curve. However, as I put it here, the monetary heroin has been removed. This is the Goldman Sachs Financial Conditions Index, which is a very useful amalgam of a range of rates, credit spreads, and liquidity conditions. You can see here how through 2020 and particularly 21 and early 22, it had been at historically easy levels. It is now starting to rise off those levels and has considerably further to go. So we think what is happening in equity markets has a fair way further to play out as the punch bowl is being removed. Just a couple of examples of some quite extreme behaviour that central bankers have driven by being so far behind the curve. This is an ETF, the Renaissance IPO ETF, which invests in all US IPOs in proportion to their size. Look at it in 2020, once central banks eased post-COVID. It tripled. Since then, it has more than halved. Another example of the lowest quality assets being hit hard, the ARC Innovation Fund. Again, more than halved from its highs. Again, a very clear linkage how it took off in 2020 when central banks flooded the world with liquidity and money chased into risk assets. Further, for a fund like this, rising real bond yields will not be a friend of long duration assets. i.e. very long duration growth stocks. Perhaps in the very short term, sentiment is overdone. The CNN Fear and Greed Index is flagging extreme fear, and it has been a very good short-term contrary indicator in the past. However, it is only a short-term indicator, so we would pay less attention when taking a multi-year view around what lies ahead. Are equities a good inflation hedge? This data from Citigroup looks at the trailing PE versus headline CPI. The clear lesson, and I've seen this in other markets as well, is equities are a good hedge until inflation gets into somewhere in the 3 to 4% region. What happens is rising inflation drives higher nominal earnings, and that more than offsets the impact of a higher discount rate of those earnings. However, once you get past 3.5%, 4%, the discount rate effect dominates. So while equities are a hedge to some extent, you then have to be very careful. For example, over the last year or two, the Venezuelan equity market has been a wonderful performer in bolivars. The discount rate effect is unfortunately dominated and seeing their exchange rate crash. So you have to be very careful and very selective in using equities as a hedge against inflation. When I first started in the industry in the early 90s, a lot of people followed the rule of 20, which suggested fair value is when the PE of the market plus the inflation rate equaled 20. I'd suggest that this will be rapidly making a comeback. Let's look at New Zealand. The 1 year forward PE for the core market peaked at an absurd 38 times in late 2020 when bond yields were down around I think it was 0.2, 0.3%. The forward PE now is a mere 27 times. Not quite as bad as it looks. The median PE is only around 20 times. Still somewhat above the rule of 20 though when you add that to inflation. Is this a fair PE or not? Following slide is the monthly forward PE for the New Zealand core market against the bond yield. Several key observations. Firstly, when bond yields get to very low levels, convexity effects take over and the fair PE starts going vertical, just as bond prices start going vertical with ultra low yields. Secondly, at the end of Feb 22, we were still somewhere to the right of the fair value line for the market as a whole, although for the median PE, we were relatively close to fair value. Thirdly, this has little predictive value in the very short term, but excellent predictive value on a 3 to 5 year outlook. And I'd observe that the market tends to get stuck in certain paradigms. So for example, pre-QE back in 2011, 2012, bond yields were 3.5%, 4%, PEs were 13, 14. We were ultra bullish, the market just couldn't turn a trick. Then Mr. Draghi came along, did whatever it took, and drove us into the current QE infinity paradigm. As you can see from the Feb 22 bullet point of the PE versus the forward bond yield, we are now in a transition phase to a new paradigm. And whether the world turns out to be a somewhat more a merely inflationary world of modest growth, or as we perhaps fear, a more stagflationary world, will determine the new paradigm that we are moving into. But make no mistake, the QE infinity paradigm that we've enjoyed for the last several years is over. So what to do? We wrote these themes actually several months ago, and they still hold good. We think inflation is close to peaking from COVID supply chain effects, but it's leaking into wages, and it will stay above central bank targets. So we very much agree with the views put forward earlier. In equities, don't fight the Fed. We've seen the rule of funds flow into equities. Some of that will flow out again. The RBA is even further behind the curve, so be very wary of some of the growth darlings in that market. Value will outperform growth. Be very careful to own equities that have pricing power in this environment. And it's very hard to fit neat labels. Probably the insurance industry is one of a few industries that clearly benefits from rising interest rates as they invest their float. But even there's offsets due to claims cost inflation. Be very wary of the retirement sector in our view. We see the New Zealand housing bubble deflating as mortgage rates rise, immigration at best being flat. And as households squeeze up in response to higher prices and higher rents, We do think that there is risk of an overbuild emerging. But when households are squeezing up over 100 years of housing stock, it does take time for that to become apparent. We also see ESG stocks outperforming, partly from flow of funds, but partly from the investment lifetime for dirty stocks shortening dramatically at present. So with that, I'm just conscious of the earlier time issues. Happy to put that rather mixed outlook for the equities to a conclusion.
Thanks, Matt. That's great. Just a question that's coming through around logistics. It's tied to tech stocks in general, and Sean may have a comment on the global supply chain issues that are going to unravel as we go through this more and more bipolarized world. But Matt, from your perspective, where do you see the logistics pressures coming through in domestic equity markets? Where is the pain points?
We've seen a lot play out already. There's a surprising amount of hoarding occurring in the companies that we speak to. There's been a surprising amount of inventory building already through most of the retailers through Australasia. So, people have, as always in these situations where you perceive a shortage, where you perceive time delays, you then hoard. It's Econ 101, and that's exactly the behaviour that's occurred. But look, there's very little sign of logistics prices falling at this point. So I think it could take quite some time from the companies we talk to unsnarl this.
So as proposed, Sean's comment around onshoring becoming more popular, you're not seeing evidence of that yet, a la military-style steel plants in Australia. That you don't see that here in New Zealand?
Not to a marked degree. The big thing we've seen, the thing about onshoring in New Zealand is we just lack scale. So in many industries, we're still far better marginally costing off someone else's scale offshore. The big thing we've seen is hoarding.
Okay. In terms of labour cost pressures, Sharon, regarding immigration, which last number was a print of minus 7K, I think, outflow of Kiwis, Matt suggesting that it's flat. Do you agree with that? And is there a wedge of young Kiwis who've yet to do their OE who will be leaving in the next 2 or 3 months, putting more pressure on skill shortages?
I think that is definitely a risk. Our forecasts assume a small positive, but certainly looking at our forecast for the unemployment rate in New Zealand and then still continuing to fall in Australia, so it's sort of converging, that relativity would suggest a negative net migration to Australia, which is actually average. That's par, is that we lose people to the country with higher wages. It's quite understandable. The question then becomes how quickly we can backfill. A few issues there. One is just simply logistics. Immigration New Zealand's a bit distracted with the residency applications from those who are already here. Anyone who Googles house prices and incomes and does the maths is likely to choose some other country. And just generally, the whole world is competing for the same skills at the moment. So, I don't doubt there'll be a flurry, but I do worry that we will probably lose people offshore, particularly to Australia, but also those OEs elsewhere. On the other hand, we are as far from Ukraine as you can possibly be, so that makes us more appealing than we were 3 weeks ago.
And none of that is flowing through into stronger forecasts by you on wage rates, wage costs.
Yeah, no, our assumption is basically that it's not going to be a flick the switch, solve the labour shortages kind of thing. Not at all. We'll win on some fronts, such as agricultural fruit pickers, but we might lose in some other areas. So I don't think those labour shortages are going to be solved by supply side things alone. It'll possibly take quite a marked slowdown. Retail and construction are two very big employing sectors that we think are going to find the going quite a lot tougher this year, for example. So that will act to bring the labour market into something more like equilibrium, hopefully without seeing the unemployment rate rise significantly.
Okay, Sean, a geopolitical question. How does New Zealand play this unfolding development with Russia and China, given our very heavy dependence on trade with China?
Yeah, I mean, we've got in New Zealand, we've always danced very well between the two main powers in Beijing and Washington, and I guess it's one of the things that our governments have congratulated themselves on over the years, that we struck the first trade deal with China, but we remain part of ANZUS, albeit on the out. We're part of Five Eyes, so we're closely aligned. But the historical alignment with the West, we're culturally, we're militarily Western aligned, but we're economically Asian. And that's the challenge that we have. Our biggest trading partner is China. So how we navigate that path, I think, is going to become increasingly more difficult as time goes on, especially given the very strident approach that the Australians are adopting towards Beijing. And I think it will be Australia's pressure on us as a nation that probably determines which way we lie on this. We'll attempt to walk the narrow path, and we're not non-aligned, but we're certainly not as US aligned as Australia is. But I think we're going to find that there'll be a point in time where we have to make a call about where our loyalties lie, and that's not going to be an easy one. So for the time being, we're fine, but I think there's a decision point down the road coming that may be problematic for us. We've got some insulation in that they need the protein that we sell, just like they need the iron ore that Australia sells. So that insulates us, but clearly they're going to try and become more and more self-sufficient in both of those areas.
Thank you. Well, we're approaching 5 o'clock, guys. We've had some really good questions that have come through that I've tried to ask on behalf of the audience. I just want to thank you, all three of you, for your contributions. Really appreciate the domestic perspective, Sharon, and your party over thing, definitely, and warnings around where inflation could go, as we appreciate. For all investors, inflation is a thief in the night, and it's great for issuers of bonds. It's horrible for investors and those on fixed incomes. So the squeeze on our standard of living, our cost of living, will continue, which will lead to more discussions at a political level, which is becoming more finely balanced in Wellington. Sean, thank you for your global overview of where reserves are going. Follow the money always, and that looks to be more of a play with Russia and China cooperating, and we'll see where that plays out and how we operate in the region, needing China as a major trading partner. And Matt, yes, the rotation to value, the rule of 20, concerns around inflation remaining above average for a long time, and being very careful around the type of equities that you own that may or may not have pricing power. So all very, very good pointers for our investors. I hope I've covered the questions well. Appreciate your teamwork with the team, and to Kylie and the CFA, Stu, thank you very much for hosting this. Be careful, everybody. Look after yourself. If you have got COVID, vitamin C, vitamin D, rest up, relax, and get better. Thank you all. Take care.
Thanks, guys.
Thank you.